Hey everyone, and welcome. Today, we're going to pull back the curtain on something pretty fascinating. How a company goes from being a private business to a public name you see on the Nairobi Securities Exchange.
Have you ever really thought about it? It's not like flipping a switch. It's this whole journey, packed with hurdles, gatekeepers, and some really tough tests. It's not just about raising cash. It's about earning the public's trust. So how does it actually work?
All right, here's our game plan. First, we'll meet the gatekeepers who run the show. Then we're going to dive into the rulebook that every single company has to follow. After that, we'll look at the different leagues a company can join. And finally, we'll get to the real reason this whole process even exists.
Okay, first things first, you gotta know the players. Think of the Nairobi Securities Exchange, the NSE, as the main stage. But before anyone gets to perform on that stage, they have to get past the bouncer. And that bouncer is the Capital Markets Authority, or CMA.
Now, the CMA isn't just some rubber stamp. It's the market's top cop, and its power comes directly from Kenya's Capital Markets Act. Its entire job is to dig in, vet every single application, and make sure only solid, transparent companies get the chance to ask you for your money. It's all about protecting the market's integrity.
And this isn't just some internal policy. It's backed by the High Court. This quote right here gets to the very heart of it. It basically says that getting listed on the stock exchange is a privilege, not a right. The CMA has the power and really the duty to be strict, all to protect investors. So, how exactly does a company get past that gatekeeper? Well, every single one of them, no matter how big or small, has to run through what you could call the listing gauntlet, a set of universal rules that are the absolute foundation of this whole process.
You can think of it like a 6-part exam. A company's got to prove its house is in order legally, be completely honest in its disclosures, hire the right team of experts, get all the tech ready for trading, promise to keep being transparent after it lists, and, this is a big one, make sure local investors get a real shot.
It really boils down to this. Before a company can ask the public for their hard-earned cash, it has to prove it's running a tight ship. It has to be a public limited company, be totally up to date on taxes, and its directors, well, they have to be vetted for both their skills and their character. No cutting corners here.
Next up is the prospectus. Honestly, the best way to think about this is as the company's ultra-detailed, no-holds-barred resume for you, the investor. The law demands they tell you everything, the good, the bad, and the ugly. The entire market's trust, as a Kenyan court has pointed out, hinges on this document being truthful.
And getting listed isn't the finish line. Not even close. It's more like a marriage to thousands of new public shareholders. The company has these continuing obligations, which means it has to keep everyone in the loop with regular financial reports and immediate updates on any big news. Transparency isn't a one-time thing, it's forever.
And here's a key rule that's all about local participation. A minimum of 40% of the shares in any initial public offering, the IPO, have to be set aside specifically for Kenyan investors. This is a huge policy aimed at making sure that as Kenya's top companies grow, everyday citizens get a dedicated chance to invest and grow with them.
Okay, so let's say a company makes it through that universal gauntlet. What's next? Well, now it has to choose its lane. See, the Nairobi Securities Exchange has two main segments, and this choice is about way more than just numbers. It's about the story the company wants to tell investors.
Seriously, the best way to think about it is like a sports league. You've got the MIMS, the main investment market segment. That's the Premier League for the big, stable, profitable giants. And then you have AIMS, the alternative investment market segment. That's kind of like the development league, built for smaller, high-growth companies that have huge potential, but aren't quite giants yet.
So what does it actually take to get into one of these leagues? Let's get down to brass tacks and look at the hard numbers.
You can see right away, the expectations are totally different. To play in the Premier League main market, you need at least 50 million shillings in paid-up capital. That's real money shareholders have put in, plus a solid track record of being profitable. But for the Development League, the bar's lower. It's less about your past profits and way more about your future potential.
And just to really drive home the kind of stability needed for the main market, we're talking about net assets of at least 100 million Kenyan shillings. That is not a small number. It's a huge signal that this main board is for companies that have some serious weight to them.
Now here's a super important rule that applies to both markets, no matter which one a company joins. It's called the public float. And what this means is, it's not enough to just sell a few shares. A good chunk of the company has to be available for the public to actually trade. And the rule is very specific. At least 25%,
A quarter of the company's shares must be held by the public. This is absolutely critical for creating a liquid market, one where you can always find a buyer or a seller, and it stops a few insiders from having total control.
And to make sure that 25% float is truly public and not just held by a handful of the founder's buddies, the rules get even more specific. You need a minimum of 1,000 different shareholders when you list. A Kenyan court actually confirmed this, saying that this idea of broad public ownership is fundamental to a fair market.
So, after all of that, the legal checks, the financial hurdles, the different lanes, what is the point? What's the big idea here? Well, it all comes back to one single, massive principle.
Everything, and I mean everything we've talked about, is designed to do this. The whole rulebook is built on transparency, good governance, and fairness. It's about making sure investors have good information to make smart decisions and are protected from anyone trying to game the system. That's how you build trust in a market.
And that kind of leaves us with one final thing to think about. This whole tough system is designed to shield investors, right? But is there a chance that these same rules might be too high a hurdle for the next great innovative, but maybe young company to clear? It's that classic balancing act between safety and growth. Definitely something to chew on.